Hello, 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 and happy Thursday. Welcome back to yet another live event where we unpack multifamily underwriting, passive investing, one step at a time. So, ground leases explained, risk considerations that investors cannot ignore is the topic I want to cover today. Very exciting, I know, but I do see those types of deals and structures more commonly as of late, and there's a reason for that, which I'll speak about. But before we dive in, for those who perhaps are tuning in for the first time and don't know me yet, my name is Vessi Kapulian, former commercial lender turned real estate investor and family enterprise advisor. I work with family offices and their family enterprises, advising them on due diligence, risk mitigation, strategic initiatives, next gen transitions, and governance. I also work with active and passive investors, helping them navigate through the complexity of the deal structure, specifically the numbers and the structure itself. And for those willing to do a deeper dive in terms of how to analyze those apartment deals, I have a course in community that I lead. And last but not least, for high achieving professionals and investors, I help connect them to well vetted cash flowing investments in apartments. I also have some very exciting news to share. Again, for those of you who perhaps are tuning in for the first time, and for the rest of you, you probably saw the big announcement last week that my book, Mastering Multifamily Underwriting 5 Steps to Confident, Risk Smart Apartment Investing, is now up and live. The very special limited time promotional pricing is still available on Amazon. As if you're looking to deepen your underwriting skills, need a refresher, or brand new to apartments and looking to learn, that will be a great way to start 2026 strong, or perhaps a great gift to give someone that you know. So let's dive in because I have quite a bit to cover with you today. I've been seeing quite a few deal structures as well as articles. Again, when I say lately, I mean the last 12 months or so, with ground lease structures. And before I dive into some of the structural considerations and things to keep in mind when you approach ground leases as a buyer looking to purchase a property that comes with a ground lease, as well as thinking through some of the financing considerations which will inevitably come into play when you call the bank to look for a loan. Let me take a step back since not all of you may be familiar with the concept, and I'll very briefly define what that is. But effectively, the ground lease is a long-term lease on the land. The lease is typically anywhere from 50 to 99 years, and the land is owned by another party. Oftentimes, you would hear them referred to as the ground lessor. And then the improvements, what you add to the land, what you do with the land, is owned by another entity, and that's the ground lessee. So if you're building, right, a property, maybe building a 100-unit apartment building, you own the building and improvements up until that lease expires, and I'll come to that point in a moment. And the land is owned by someone else. Very often, once that lease expires in 99 years, ownership and improvements typically revert to the landowner, but you have to read the lease agreement to determine what actually takes place, because all of these points are negotiable on what happens and what takes place once that lease expires. Those types of leases are really not at all uncommon in urban areas. Like New York is well known for that. For institutional real estate, special projects around port areas, for example, where maybe the port owns the land, but you own and lease the warehouse located on that parcel of land. Not at all uncommon in hospitality and increasingly in multifamily. And I see a lot of people resorting to those creative structures because sometimes it helps break up the cost of the investment. And with more recent regulation, especially here in LA, people are in certain additional tax obligations that are being imposed on properties over a certain dollar limit. It's getting people to get creative in terms of how to break up the entire purchase to a place where it becomes more affordable. So as I mentioned, there it's important to recognize that there are two legal entities, right? You first have the land, and that's the fee simple estate owned by the ground lessor. It's typically free and clear. Very rarely you would see that encumbered by debt. And then you have the leasehold estate, which are the improvements that these are owned by the ground lessee, and this is effectively what will most likely get financed, right? If you're buying that type of property. And so in that case, the lender would require a leasehold title insurance policy, not a fee simple traditional title policy, which will really have to speak to the validity and enforceability of the ground lease, the priority of the leasehold mortgage, no undisclosed superior liens, and so forth. And so title risk is really important to clear up front to clear the path, right, for financing. Second of all, when you go to a lender, they will definitely want to understand the underlying lease structure and lease provisions, because it will be really important when they file a lien, right, on the improvements, because again, they cannot encumber the land since it's owned by someone else who will likely not be pledging the land to the lender in this scenario. They want to understand, is their lien going to be perfected, meaning not just on paper, but if God forbid in a worst case scenario, they can actually access the property. And I've been in deals where the landowner would not agree to that, and those deals fell apart, right? We couldn't finance those deals. Again, that was years ago when I was on the lending side of the equation, but for you as a property owner, you want to flush out those points up front before spending months and thousands of legal fees and diligence reports and legal documents only to be told no. So you want to make sure those points are clear. Secondly, yes, these leases are long term, 50 to 99 years, but as a lender, you always think, what's my exit, right? As an investor, you always think, what's my exit? And so if they have a term that say 20-25 years, that's just not enough time, because most projects typically have a 5 to 7 year hold. And at that point, by when you're ready to exit, now all of a sudden you have 10 to maybe 15 years left on the lease, which then creates a risk for any incoming buyer on what's going to happen, right, when they're ready to exit the property. So thinking through that, and the lender may not even be comfortable with that short remaining lease term. So another important point to clarify up front. And then last but not least, last but not least, understand how the lease is structured from a rent perspective. It's not uncommon to have fixed rent escalations. Some may be tied to inflation, certain step up levels predetermined at particular time points. But I was reading an article not too long ago by TREP where they discussed. I wish I had saved the article. It was a prominent apartment building in, I think it was apartment building in New York, where the rent expense increased exorbitantly. I mean, I'm not talking 50%, I'm talking higher than that, which in turn created severe cash flow uh, um, issues, right, for the property owner. And now the property is in default because, again, I'm not sure they didn't read the lease or forgot about it, or what exactly happened, but that wasn't, it sounds like that wasn't necessarily accounted for or baked into their projections. So really important to understand what these rent escalations look like or potentially look like and when they come in. Again, that's important not only for the existing project, but as you think through your exit strategy. And the lender will be evaluating that as well, so they can figure out if they're comfortable with the overall risk profile. So for these types of projects, again, not uncommon to see a lower loan to values. I already covered the importance of understanding the lease and lease term, title considerations, access considerations, and last but not least is cash flow, because in addition to your fixed charges pertaining to debt service, you also have the recurring lease payments for leasing the land. So the lender will be definitely capturing that in their debt service coverage or cash flow calculation. So you want to make sure you account for that. And again, to cover the risk, not uncommon to see the loan structured with lower loan to value. If you're looking at agency financing, definitely talk to a loan broker, because some may be more flexible than others, but not a typical or standard projects that they get into. But again, talk to a loan broker, because the agency's appetite is continuously fluctuating and changing. And so, as you're entering into those opportunities, whether as an investor, another important factor to bake in is the additional lead time, because you are adding another uh, entity to the party effectively, right? So there will be additional negotiations involved, additional documentation, including tri-party agreements, right? That the lease owner will have to agree to when it comes to any additional requirements that the lender may have. More conditions, precedent closing that the lender would require, and like I said, additional diligence. So can be a very attractive option, right? Especially if their cost consideration and you're looking to break out the investment into uh, pieces. But if you are coming into an investment with a ground lease, it's important to understand the some of the considerations that I just looked at, and especially when it comes to your exit strategy, it's imperative to think through that, because again, what may be attractive to you today may be a concern or turn into a completely unfinanceable asset down the road, which again will impact any potential buyer. So again, wanted to pop up for a few minutes and talk about a topic that I seem to get more questions about lately, and also I've been seeing more deal structures with that with ground leases than usual. Again, not this is not new at all. They've been in existence forever. But given current market conditions, I'm not surprised to see those occurring more frequently. And if you're tuning in for the first time, I usually pop up every Thursday afternoon, unless I have to move it to another day for due to scheduling constraints. And if you'd like to be notified of those events, follow me on LinkedIn and YouTube, so you would get notified. I'll probably start doing more Q&A, ask me anything, sitting in the hot seat type of events as well. So always welcome your questions, interactions, and let me know what topics related to underwriting, passive investing, apartment deal vetting you're interested in learning more about, I'm happy to cover those. If you'd like to learn more and take a deeper dive, I actually have a holiday special, 30% off the course and community. I will drop the link in the comments below, especially for those of you who I know will be catching the replay of this live event. And if you haven't done so already, claim your copy of Mastering Multifamily Underwriting, 5 Steps to Confident, Risk Smart Apartment Investing. Today, it is available on Amazon and hardcover, paperback, digital, audio, however you'd like to consume your content. I would very much love to hear your thoughts after you do a deep dive. And I will see you the week after because next week is Christmas. So I'm gonna take a break next week, so no live event on Thursday. But I'll see you the week after. I wish you a very blessed, peaceful Christmas, happy holiday, Hanukkah, whatever you're celebrating with family and loved ones. Ciao.